and welcome back to Q News. I'm Raham Morsi, and we continue our special economic news coverage for the fourth consecutive day, bringing you the top stories and expert analysis on the events and trends that shape the regional and global economy over the year. Throughout our coverage, we'll spotlight the most influential sectors and highlight the defining economic stories of 2025. Before we begin, let's go to our colleague, Basant Chahata, for a look at tonight's top economic stories. Basant, what do you have for us?
Thank you, Raham. Plenty of economic news tonight, starting in the United States, where new unemployment claims fell unexpectedly last week, but the labor market remains sluggish. The Labor Department said that initial jobless claims dropped by 16,000 to 199,000 for the week ended December 27th, beating forecasts of 220,000. Claims have been volatile around the holidays, and economists say hiring remains weak despite few layoffs. Continuing claims fell to 1.866 million but stayed above year-ago levels. The unemployment rate, which hit a four-year high of 4.6% in November, is expected to have remained unchanged in December. The Federal Housing Finance Agency has said that U.S. home prices rose 1.7% year-on-year in October, the slowest pace since 2012, signaling improved affordability. On a monthly basis, prices increased 0.4%. Regionally, ranged from 0.7% drop in the lower Midwest to 5.3% rise in the Mid-Atlantic. Moving on to Asia, China's state planner has approved a 295 billion yuan central government investment plan for 2026 aimed at boosting growth through infrastructure spending. The National Development and Reform Commission said about 220 billion yuan will fund 281 projects tied to major national and security-related priorities, including underground pipeline networks. More than 75 billion yuan was also earmarked for 673 projects in areas such as ecological protection and carbon reduction. The plan is intended to support growth and a smooth start to China's 15th five-year plan 2026 and 2030. Moreover, President Xi Jinping has stated that China will implement more proactive macroeconomic policies next year to support growth. Xi said the economy is expected to grow by about 5% in 2026, reaching roughly 140 trillion yuan. Speaking at a New Year's tea party attended by senior Communist Party officials, he said China would pursue higher quality growth while maintaining a reasonable pace of expansion.
我国经济总量连续跨越新关口，今年预计达到。
The Commerce Ministry has announced that China will levy additional tariffs of 55% on beef imports from countries including the US and Brazil when shipments exceed set quotas. The measures will take effect January 1st, 2026 and remain in place for 3 years. China has urged the Netherlands to reverse what it called mistakes over its intervention in chipmaker Nexperia, saying the move has disrupted the global semiconductor supply chain. The dispute stems from the Netherlands taking control of Nexperia, a unit of China's WingTech, to prevent technology transfers to China. Beijing retaliated by blocking Nexperia chip experts, while the Dutch government has defended its actions despite pausing the intervention in November. Still in Asia, where the Indian government has said in its end-of-year economic review that New Delhi surpassed Japan to become the world's fourth largest economy with a GDP of $4.8 trillion. Officials project India would overtake Germany within 3 years, reaching $7.3 trillion by 2030. IMF estimates for 2026 put India at $4.51 trillion, slightly above Japan's $4.46 trillion. The government attributed the growth to India's resilience amid global trade uncertainties despite U.S. tariffs on Russian oil imports and a weakening rupee. While GDP growth is strong, per capita income remains low at $2,694, far below Japan and Germany, highlighting ongoing challenges in creating quality jobs for India's young population. South Korea's consumer inflation slowed to 2.1% in 2025 from 2.3% in 2024, bringing it close to the Bank of Korea's 2% target and supporting expectations that interest rates will remain unchanged for longer. The central bank kept its benchmark rate at 2.50% on November 27 for a fourth consecutive meeting, signaling it may be nearing the end of its year cut cycle. In December, consumer prices rose 2.3% from a year earlier, in line with forecasts, while monthly inflation came in at 0.3%, slightly above expectations. The Turkish Statistical Institute, Turkstat, has reported that Turkey's foreign trade deficit widened to $7.9 billion in November, up 6.3% from a year earlier. Exports rose 1.3% to $22.5 billion, while imports increased 2.6% to $30.5 billion, leaving an export-import coverage ratio of 73.8%. Excluding energy products and non-monetary gold, the trade deficit was $1.85 billion. For January and November, exports reached $247 billion, up 3.6%, and imports totaled $329.7 billion, up 5.7%, leaving an 11-month trade gap of $82.7 billion, a 12.6% increase. Oil prices were little changed on Wednesday, but headed for a fall of more than 15% in 2025 as expectations of oversupply increased in a year marked by wars, higher tariffs, increased OPEC Plus output, and sanctions on Russia, Iran, and Venezuela. Brent crude futures were down over 17%, the most substantial annual percentage decline since 2020, and were on track for a third straight year of losses, their strongest ever losing streak. U.S. West Texas Intermediate crude was headed for a near 19% annual decline. Precious metals are closing 2025 with record gains. Gold rose about 65%, marking its biggest annual increase in 46 years, despite a slight drop to $4,332 per ounce. Silver surged over 151%, its strongest year ever, hitting a record $83.62 recently, before easing to $72.83. Platinum jumped 127%, reaching a lifetime high of $2,478, while palladium gained 78%, its best performance in 15 years. The rally was driven by Fed rate cuts, geopolitical tensions, central bank buying, and investor demand. Global stock markets ended mixed on Wednesday as investors wrapped up 2025 with modest declines in US and European indices offset by gains in parts of Asia. In the US, the S&P 500 slipped 0.23%, the Dow 30 fell 0.23%, and the Nasdaq edged down 0.19%. In Europe, the FTSE 100 in the UK fell 0.09%, while France's CAC 40 dipped 0.23%. In Asia, the Shanghai Composite gained 0.09%, but Hong Kong's Hang Seng declined 0.87%. And that wraps up tonight's top economic stories. Over to Riham, who will guide us through the macroeconomic events that shaped 2025. To you, Riham.
Thank you so much, Basant. As 2025 comes to a close, the world economy was shaped as much by geopolitics as by markets. Trade wars, energy shocks, and strategic alliances redefined global power, while crises from the Middle East to Ukraine sent tremors through markets and supply chains. From tariffs on China and Europe to soaring gold prices and volatile digital assets, this year reshaped economic landscape and set the stage for a turbulent 2026.
As 2025 draws to a close, economics and geopolitics become inseparable, reshaping trade, energy, and global power while setting the stage for a volatile 2026. Donald Trump's return to the White House marked a pivot towards protectionism, reshaping U.S. trade policy and global alliances worldwide. In April, Washington imposed sweeping tariffs on China and Europe, which triggered market volatility and prompted retaliatory trade measures around the globe. During his May 2025 Gulf tour, President Trump announced over $2 trillion in economic and investment deals across Saudi Arabia, Qatar, and the United Arab Emirates, focusing heavily on technology, defense, and aviation. For its part, Beijing responded by restricting rare earth exports critical to tech and defense, exposing global dependence on strategic minerals. Meanwhile, Britain moved quickly, signing a trade agreement with the United States, reinforcing bilateral ties on global trade fragmented into competing blocs. Shortly after, the United States and European Union signed a strategic trade and investment deal aiming to coordinate on technology, energy, and market access. On another note, tensions in the Red Sea disrupted one of the world's most vital shipping routes, and this sharply raised freight costs and global supply risks. At the same time, Israel's strike on Iran escalated tensions across the Middle East, threatening the Strait of Hormuz and pushing oil prices higher while raising global energy risk premiums. In response, OPEC Plus cautiously increased output to stabilize prices amidst geopolitical shocks and slowing global demand. The conflict in Ukraine intensified into a prolonged stalemate, highlighting the limits of Western sanctions and military influence. Subsequently, Russia and India deepened energy and trade cooperation, strengthening parallel economic routes outside Western frameworks. Meanwhile, Europe faced mounting pressure from weak growth, rising debt, and political fragmentation across key economies. In France, budget disputes triggered political fallout, reflecting broader fiscal stress across the Eurozone. The EU and Egypt held their first strategic summit, launching cooperation frameworks exceeding 7.4 billion euros across trade, energy, and investment. During the last quarter of the year, the United States government experienced its longest shutdown, lasting 43 days, cutting up to $14 billion from GDP and shaving 2 points off late year. Digital assets and AI-driven markets saw extreme swings as investors reacted to ongoing economic shocks and geopolitical uncertainty. These events drove investors towards gold and defense assets, with gold prices surging over 60% in 2025 amidst global risk concerns. As the year ended, US-Venezuela tensions resurfaced, tightening sanctions and adding uncertainty to global oil supply. Unresolved crises leave 2026 defined not by recovery, but by risk.
For further analysis, we're joined from London by the political and economic advisor, Babak Emamian. Thank you, sir, for joining us here on Q News, and Happy New Year to you.
Thank you, and Happy New Year to you.
Let's start off here by asking you, how have the US tariffs and the protectionist policies reshaped global trade this year?
Well, if we look at it, all the predictions by the academics and economists was that the inflation would be much higher than it is now, and the growth would be much lower than it is. They were predicting the US economic growth would be around 1.7, even maybe lower. And now we find out it's around 4.3%. And they said the disruption in the supply chain would cause higher inflation, and inflation would go higher, but the inflation went down. So 2025 proved to us that the models that the academics and the economists work on them, these models are out of date. And the people who actually are involved in the real economy, like President Trump, and the builders and the entrepreneurs, they have a much better grasp of the economy and what is going to happen. But unfortunately, most of the central banks and most of the institutions that feed data to central banks are occupied by people from left of politics, people from academia, and mostly economists who just sit behind the desk and they've never been involved in real life.
Well, now we've seen the US, the UK and EU sign new trade deals. Are we somehow seeing a move towards some sort of competing trade bloc in the next year, for instance?
Well, we've had a discussion before that the trade deals are very good, but trade deals do not mean trade. For that, you actually need entrepreneurs, business people, manufacturers from each country to trade with the other ones. And you need to have products that you could sell. And you need to create demand on the other side. So trade deals are done by politicians, and they are oversold as though if you have a trade deal, automatically it would lead to trade. That's not the case. For actually trade to happen, you need to have great products, and you need to be able to create demands for your products. And that's the job of entrepreneur business people. And for that, they need less regulation, they need lower taxes, and they need investment. And unfortunately, the governments in Europe are not helping the entrepreneurs, manufacturers, and traders in Europe.
Okay, if we can go to the Middle East. Now, how have the Middle East tensions and the Red Sea disruptions impacted oil prices and energy security overall this year?
Well, the good thing about Middle East is actually it's divided in two parts. There are countries that they just want to cause mayhem and chaos and create conflict. And then there are other side of the Middle East who are dedicated to growth and prosperity. And fortunately, the ones who are dedicated to growth and prosperity are winning now. They are doing much better than expected, and they have a strong team. And they work with everyone on that basis. So I see the future of Middle East very bright and much better than expected.
Well, how do you think, I mean, I understand where you're coming at here, but how do you think that the disruptions, because there were disruptions in 2025 to supply routes, how has this affected the global economy and energy prices?
Well, that's a great question. We had globalization, which started in 1992, globalization 1.0, which then all the jobs went to China. And by going all the jobs to China, all the foreign direct investment went to China. Then we had, during the President Trump first term, globalization 2.0, which that meant all the jobs went everywhere. This time did not go just to China. And so foreign direct investment went to other countries, not just to China. Now we have globalization 3.0, which means all the jobs going to US and all the foreign investments now going to US. So when President Trump talks about 18 trillion direct foreign investment into US, that's the money that is not going to China. It's going to US instead. So there is that big reindustrialization in the West, especially in US, which is a good news for the Western hemisphere.
Okay, if we could somehow look ahead, which indicators or key indicators should investors watch to gauge the global economic risk in 2026?
Sorry, could you say that again, please?
If we can look ahead at 2026, what key indicators, in your opinion, should investors look for when it comes to global economic risk?
There is that issue about AI, that AI will produce more productivity. So there is lots of investment going towards artificial intelligence, which is a very interesting thing. But the more interesting thing is we are following the same company models, the same the trade models as before, that the winners takes all. Now, allow me to explain that. For example, in 1960s, when the fast food was growing, the winners like McDonald's took everything. So the winners took over, and the second and third were not there. Similarly, now we find with AI, whoever comes first takes everything. We had the same thing like in 1990s and early 2000 with the search engines, which Google came first and it took everything. Similarly, later on with Facebook. Facebook came and it took everything. There is not a second or similar company to Facebook. So it seems the winners takes all model still exists. And that's what we see. So if where one should avoid is investing on second or third. Yes. Try to invest on the first.
Okay, thank you so much from London. That was the political and economic advisor, Babak Emamian. Thank you for your insights and thank you for joining us. Looking ahead to 2026, global growth is set to remain positive, though below pre-pandemic averages. Forecasts from major institutions show a cautious outlook, with projections ranging from 2.4% to 3.3%, signaling steady but moderate economic momentum worldwide. For further analysis, we're joined from Paris by the director of the World Pensions Forum, Nicholas Fitili. Welcome, sir, to Q News, and Happy New Year to you.
Thank you.
Let's start off here by looking at these forecasts. Is 2026 about resilience or slowing momentum?
Delighted to join you today, and Happy New Year to you and your viewers. I think, it's going to be a complicated year. So basically, the top line, the general macroeconomic perspective is, I think, cautiously optimistic. So on average, in many countries, real economic growth will be improving a little bit. And here the key word is real. So it means that inflation should be tamed, right? So this year, 2025, was a transition year. In many countries, there was lingering inflation, which made many investors fearful that we hadn't been able to surmount that wave of inflation. But now things have stabilized. So for example, in America next year, real GDP growth, when I say real, accounting for inflation, will be around 2.1, 2.2%. In countries like Colombia and Latin America, for example, real economic growth will be above 3%, which is very good. Many countries will be growing nicely. So there's only one problem. I mean, there are two problems I see for next year. First is Europe, including the UK. So here, economic growth, real economic growth, will remain weak. So I think, Germany, France, Italy, England, Britain won't be able next year to have a strong GDP growth engine. And that will be a problem for the economy. That will be a problem for employment. I think, unemployment is going to rise quite steeply in most European nations next year, including the UK. So that's not good. And then if we look at oil producing, many oil producing countries next year, they will suffer, including countries, of course, like Iran, Iran, Iraq, Algeria, etc. Even in Asia, right? Malaysia, the oil producing part of their economy will suffer. I think Saudi Arabia and Abu Dhabi or the Emirates will do okay because the production cost for oil and gas in Saudi Arabia and the United Arab Emirates is quite low, and they have huge reserves. But I think, for countries, for the other OPEC members, things will not be great.
Yes.
I think, it's a strange irony. I think Russia will do quite well next year. And one of the reasons why Russia will do well next year is oil, gold, and silver. So Russia has...
Yeah, I mean, I understand what you're saying, that it depends on the region. But do you think, in your opinion, that possibly the driver of this global slowdown, where the IMF forecasts a 3.1% growth, is mainly the Europeans and what's happening in Ukraine? Or are there other factors that are leading to this global slowdown?
So yes, you're right. So the Ukraine story, the fact that the Europeans decided to focus on Ukraine, which is not an important issue, unless you are Estonian. If you are Estonian, Lithuanian, Polish, maybe it's important. But other European countries, including the big ones, Germany, Britain, France, who have very little economic interest in Eastern Europe, they chose to allocate time and resources on that issue to the detriment of their own economy. And now importing, natural gas. It's crazy. The Brits and the Germans and the French are importing natural gas every day from America and Qatar at a very high cost because they don't want to deal with Russia. And it's really economically, financially, it's very stupid, right? It doesn't make any sense. So Ukraine and the silliness of European policymakers is part of the story, but it's not the only story. The other story is industry. I think the Europeans, regardless of Ukraine, many of them, the policymakers, believed wrongly that heavy industry, machine tools, steel mills, etc., and the mining capacity which goes with it, they decided it was not important. And now the world is changing, right? America is reindustrializing very rapidly. China is industrializing as fast as ever. And even, even emerging markets, even, Saudi Arabia, like I said, Abu Dhabi, they are taking industry very seriously. They think that to be strong in the new world economy, you have to be diversified. Don't put all your eggs in the same basket, and have a diversified industrial base, right? And the only part of the world where they don't believe in industry and R&D seems to be Europe. And in the long term, that is economic suicide.
Okay, so the bottom line here, is 2026 a stable growth year, or just a pause before new shocks start to appear?
I think we may see shocks in, even though next year I think the situation will be quite good, we may see shocks. So we may see shocks because, look at what's happening now in Venezuela, right? Look at what's happening in Iran, in Israel, in Ukraine. So yes, we'll see shocks, but I think the world economy matured. So I think the world economy, especially countries like America and China, are prepared for the shocks. Because, what Trump did in the past 7 months is quite formidable. He has started an industrial revival of America. He was able to impose that 15% tariff on Europe, 10% on England or Britain, and more importantly, many industrial companies like Rolls-Royce, BMW, Mercedes, Saab, ThyssenKrupp, they're transferring their factories and R&D labs to America, right? So even, the most successful industrial, whatever, successful industrial R&D capacity the Dutch and the Germans and the Brits have, they're transferring to America. And look at, South Korea. South Korea and Singapore are also transferring a lot of R&D and industrial production capacity to America. So I think we're witnessing the beginning of a victory. It's a delicate, cautious victory, but still I think, the industrial machine in America will be humming next year. Likewise in China, your previous guest said rightly that China had lost a lot of investment. It's true. So many pension funds, many big pension funds and sovereign wealth funds from the West, they are investing less in China. So the foreign direct investment from New York, Montreal, London, Zurich to China is going down. It's collapsing. That is bad. But the Chinese were prepared for it. They're prepared for the shock. And now they're relying more on their own pool of domestic capital. They have huge reserves. So what I'm coming at next year, we'll see an acceleration of that Chinese-American industrial rivalry. And I think, it's going to be interesting to watch, because even AI, America's ahead, but we're seeing, companies in China like DeepSeek, like StepFun, Zippo, Minimax, which are really coming up with new concepts every day almost.
Okay, thank you so much from Paris. That was the director of the World Pensions Forum, Nicholas Patelli. Thank you so much for joining us, and Happy New Year to you. This concludes the final episode of our special economic coverage recapping the year. Over 4 consecutive episodes, we highlighted the top and most dynamic sectors of 2025. Join us tomorrow as we kick off the new year, and Happy New Year. Next, we turn to the sports to discuss the AFCON and the latest events with Mark Summers. Don't forget to follow Q News on YouTube, Facebook, X, Instagram and TikTok using the handle @QNewsEGY to stay informed. Thank you for watching.